Hello everyone, I am Michael Ruger. I'm the managing partner of Greenbush Financial Group, and I'm here today with my partner Dave Wojeski, who's also the managing partner of the Wojeski & Company accounting firm. The topic we're going to be talking about today is the PTET deduction, which stands for pass-through entity tax. It's a huge deduction for business owners. It's a way for them to kind of get around that $10,000 cap that they put on the SALT deductions a few years ago. And if you are not in New York State and you're watching this, the other states do have PTET and like 31 other states. It could be slightly different than New York, but you will get a lot out of this video just understanding how these programs work in general. So I think with that, do you want to just go in a little bit about, why PTET came about, like how the deductions work? Sure. And why it's valuable to small business?
Yeah, I mean, it's got a lot of value specifically for two reasons. One is, the last Trump Tax Act they had, they limited the SALT deduction, which is state and local tax deduction, which is part of your itemized deductions. So it used to be whatever your real estate taxes are, whatever your state withholdings were, which includes the New York State tax, you would add that up and you get a tax deduction for that on your federal return. And then basically, taxes are a symbol of wealth, of income, because that's why you pay tax. Real estate is market value tax, and then income tax is obviously income tax. And so it was a way to say, hey, let's get rid of AMT, or at least raise the limit on AMT and limit people's deduction for the taxes, and they limit it to $10,000. So that was a killer to people who had in the northeastern states, where your real estate taxes are high and your state taxes are high. So your real estate taxes, if they're already at $10,000, that means you're not deducting any of your state taxes, which is a big deduction. And if you're in a tax bracket anywhere between 22% and 37%, you're losing 22 to 37% of every state tax dollar you pay. So all the northeastern states were trying to find this workaround. And the way they did it is they said, okay, we can take care of it for the people who have pass-through entities. Because partnerships and S-corps, they have flow-through income. You calculate the income at the entity level, and then they will normally didn't pay a tax at that level, no state tax. It would just pass through to the individual. And so they came up with an idea that, we'll tax the entities at the entity level, and we'll give a credit to the partners and shareholders. So essentially, it's as if the pass-through entity is paying the tax on behalf of the individual. So if I had $100,000 of income and my individual tax on that was going to be $10,000, my entity would now pay the tax. The entity would get the tax deduction, so my entity income would be lower by 10 grand, and I don't take it on the individual side because I'm getting it already on the entity level. And then when I get to my individual return, that $10,000 that the entity paid, I'm going to get a credit on my state, as if it was a New York State withholding on your W-2. So, I mean, it's a no-brainer. It's a huge win for anybody who's able to take advantage of it, because they're saving anywhere from 22 to 37% of that number.
Right. And now you mentioned the partnerships, S-corps. What if you have a sole proprietor? So they're not incorporated right now. Like, what do they do to kind of say, do you have to then go incorporate in order to capture this?
Yeah, you'd have to become an entity. So an LLC is generally taxed a partnership, but a single member LLC is just a sole proprietorship. So you'd have to either add a partner, so maybe you add husband and wife could become a partnership, or you could elect to be an S-corp. You'd have to make, there's reasons why you're a sole proprietor, there's reasons why you're a partnership or an S-corp. So you'd have to weigh whether the pass-through entity tax deduction, to take advantage of that, makes sense to change your entity classification. But we're definitely seeing a lot more of that.
Now, when did this all start for New York? Like, when did they start the PTET? What tax year was it?
2021.
Okay, gotcha.
So we'll have it 2021. This is the second year of it, and it was a little bit of a bumpy ride last year, but less bumpy this year.
What was the deadline? Because there's a deadline where you actually have to go online and say, okay, I want in the program. Like, what was the deadline to do that for 2022?
March 15th. So March 15th for the entity. The entity itself has to make the election to want to participate in the program. Because you don't have to participate in the program. You don't have to make this pass-through entity tax. But in most instances, if you have a lost corporation, obviously it doesn't matter. But if you have a for-profit entity that makes a decent amount of money or a little bit of money, you probably would want to elect into this.
So if you missed it, if you're watching this now in November 2022, you're pretty much out for 2022, and then you have to wait till 2023 to then make that election by March 15th to say, hey, for 2023, I'm in, and I want to be able to capture the deduction.
Yeah, so maybe if you've got timing on income at the end of the year, maybe you push some of the income into 2023, if you can, to have higher income in 2023 when you will elect into PTET.
So let's assume you made the deadline, you made the election in 2022. Like, what's the actual process of making the election? Like, where do you do that?
Well, a taxpayer, generally you work with your accounting firm and they usually help you do a lot of these elections. Like, the normal process is, if you have to do S election or anything, you tend not to want to rely on the client because that's not what they do for a living. But in this New York State, we can get powers of attorney and do certain things and get onto the New York State Business Services logon, which gives us access to a lot of the things that you do on behalf of a client. But in this case, the client has to make the election. So the state was pretty good actually about notifying the client and saying, hey, we've got this PTET thing out there. You might want to consider it and get into it. And a lot of clients would forward it to us, but they would actually physically have to go in. And it was not a really easy process because you had to, first of all, have a business services logon. So you had to set up an account. Yeah. To set up an account and log in, you had to know certain things about your tax return or your sales tax return, your payroll tax return, and people just struggle with that sometimes. So, we would help them out if we knew about it, but, if someone missed the deadline, it was unfortunate that we couldn't just make the election on their behalf. It would be a lot more efficient.
Now, once people are in, so if I was in this for 2022, do you have to go log back in and make this election every single year, or once you're in, you're in?
No, you got to make it every year, unfortunately. Gotcha. I wish it was an opt-out.
Yeah, 100%.
Because even if... I guess it doesn't matter really either way. But there are years you'll want to opt in, and the years you probably won't. It is an annual election, but it is a different process, right? It's different. If you're in a tax software, it's different. You're doing a different process through the web. It's a web tax return. It's a web login, and it's just another compliance piece,
So you get in the program, and then the entity has to start remitting those estimated tax payments to, in our case, New York State.
Right.
So how is that, business owners are used to their estimates and cutting theirs based on their own personal tax liability. How does it work for the entities? What are the estimate deadlines different throughout the year than for personal? How does it work?
Yeah, the process is a little different. The way you do the process is the same, right? You have to, for your individual estimates, you kind of have to know what your income level is going to be. It's the same at the entity level. You have to know what the entity level's income is going to be. So, your estimate payment due dates are March, June, September, and December 15th. We can do that on behalf of taxpayers, and you have to have access to the bank account because it's all done electronically. Or the easiest way, honestly, is if you kind of can project out what your income is going to be, and your income for the year is going to be $100,000, and your PTET tax is going to be $6,500, and that every quarter it's going to be $1,700. Then you can actually set it up electronically ahead of time and go into the system, the state system, and say, hey, March 15th, June 15th, September 15th, December 15th, auto withdraw $1,700.
Automatically.
Then you're done.
Yeah.
You just have to remember that you've done that so you don't bounce in checks and something come up in September. Right. But it's probably the most efficient way to do it. But it is just a projection thing. And then most of the time what we would do is look at the end of the year, right? Because you're kind of at the end of the year, you think you're going to make $100,000. And at the end of the year, if you're going to make a lot more than that, you would want to make that PTET payment before the end of the year because you're going to get a federal tax deduction on your pass-through entry tax return if you make it during the year.
So as a business owner, now that I'm used to the estimates, I have to cut my federal and state. Once I'm in the PTET program, now do I just remit my federal and I don't have to worry about the states anymore?
For most of the time, yes. But remember, your PTET estimate only covers your PTET pass-through income.
Gotcha.
So, but if the majority of your income is pass-through income, your state tax is going to be covered. But that's not usually the case. Most people have investment income or something else going on that's not covered by PTET.
So there could be some state estimates that are still due.
I would say most of the time we're having, if your estimates were $10,000 a quarter before, now they're $1,000 because you're only covering the shortfall of non-PTET related income.
Now let's go through the mechanics of the actual tax return. How does that kind of deduction flow through to the actual business owner?
That's exciting.
Yeah.
So this is the complication with the program. When it was implemented, there's a lot of things when you start going through it, how it works. And it just, the tax return itself is actually relatively simple for a tax return. It's just piggybacks off the federal return, which flows through to the New York return, and then you have your specific New York adjustments, and then that income is multiplied by whatever the tax rate is of that income. So that's a pretty easy process. It has to be filed separately online, the web filing. The tricky part is, what's defined as New York income and how you calculate the PTET based on that New York income. So if you and I are New York residents and we're New York partners and all our income is in New York, it's pretty straightforward. It's going to be your total New York income times the rate, and we pay our tax on it. Where it gets tricky, and we'll separate partnerships from S-corps because they're treated differently. With the partnerships, if you have a resident partner and a non-resident partner, the theory behind the pass-through entity tax is that it's supposed to cover your New York State taxable income. So if I'm a resident partner, my income is going to be sourced to New York, at least all of it is, although I may have some non-New York income. But if you're a New Jersey resident, you and I are partners, and we have no New Jersey allocated income in the partnership return. And that gets into partnership rules, which we probably won't address on, but we'll make the assumption that there's no New Jersey income. We make $100,000, $50,000 allocated to me, $50,000 allocated to you, multiply it by, let's use 6%, it's $3,000. The entity cuts a check for $3,000, but only I get the benefit of that because I'm the one who's benefiting from the pass-through entity tax. The partnership gets a deduction, you'll get a deduction for your share of it. But remember the $3,000 that PTET represents, it represents my state tax. So the entity is now paying my state tax. You're a partner. Like, it's not equitable really that I'm getting a $3,000 benefit out of the partnership, but that's how the rules work.
Gotcha.
So you either have to then figure out within the operating agreement or within the partnership whether there's going to be some kind of true up or whether that's just, it is what it is. But you think about it from that standpoint, if you have, and that's where the election becomes a little trickier. If you have 25 partners and 11 of them are non-residents, it can be a very tricky allocation of what you do with the income, on top of the fact that it can be some big dollars that are only going to a select number of partners.
Right.
So that's the hard part on the partnership side. On the S-corporation side, which is just different rules how S-corporations are taxed, if we're all, and this is where the rules changed. So
from 2021 to 2022.
Yeah, so in 21, I guess it doesn't matter, but just to give you history, in 2021, if our S-corporation shareholders and we're New York residents, but our allocation of New York income, so our sales were mostly out of New York. Let's say 10% of our sales were were in New York. We would only get a credit for 10% of the income flowing through, even though 100% of that income is going to be taxed to us in New York as we're residents. Yeah. And I think, there was a lot of probably flack about that in New York, and New York did the right thing and said, oh, wait a minute. If you guys were S-corp shareholders and you're 100% residents, then everybody can take advantage of the full pass-through entity tax and take it based on the S-corp income. However, if you have non-residents now, that's not going to work that way. It's going to go the old way, which is then everybody is going to get their allocation of the New York apportionment. So whatever the S-corp has as New York apportionment, that's going to flow through to everybody. And the downside of that is, because it's an S-corp, you can't specially allocate income like you can in a partnership. In an S-corp, it's going to follow according to your ownership percentage. So in that point, you're going to have a New Jersey shareholder who's going to get a pass-through entity tax credit from New York State that they may or may not be able to use. Gotcha. But it's going to be based on ownership. So it's still much better, but if you have a complicated or resident and non-resident shareholders or partners, you probably have to look at it a little bit more. If you're resident S-corp, resident partners, and you're all residents of New York State, it's somewhat of a no-brainer to elect into it. I mean, there's some extra compliance costs. You got the estimated payments you got to do. You got to pay your accountant to do a little bit more. Yeah. So, if you're saving just a few $100, it's not going to make sense. But if you're going to save, thousands of dollars, it probably is going to pay for itself.
Now, besides just the S-corp change that happened, I saw somewhere that for 2023, there's this New York City PTET that's coming on board, like starting January 1st. Like, what's that? Like, what's the difference?
Well, New York City has its own tax, right? So it's got the entity tax, and it's got you pay New York City resident tax. But there wasn't, the pass-through entity tax is a New York State tax. So this is just the same program that New York City has implemented to elect into for 2023. So if you're a resident of New York City, same thing. You're going to look at the same way you do as if you were a resident of New York State. It's probably going to make sense.
Well, I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thanks, guys. Bye.